Now let's proceed with ratio analysis or financial ratio. Ratio analysis is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statements, such as the balance sheet and income statement. Financial ratios are grouped into the following categories: liquidity, efficiency ratios, solvency, and profitability. So let's discuss it by one. The liquidity ratios. Liquidity ratios measure a company's ability to pay off its short-term debts or short-term obligations as they become due using the company's current or quick assets. The commonly used ratios to measure liquidity are the current ratio and quick, or also known as the acid test ratio. The current ratio. It is the ratio of current assets to current liabilities. So the formula will be current assets divided by total current liabilities. Take note that the industry standard for the current ratio is 2:1. It indicates that current assets double the current liabilities are considered to be satisfactory. The higher the value of current ratio indicates more liquid of the firm's ability to pay its current obligation in time. On the other hand, a low value of current ratio means that a firm may find it difficult to pay its current liabilities. So here's an example on how to compute the current ratio using the financial data of Tyson Foods Incorporated. So all we have to do is to find the quotient of current assets and current liabilities, which is 5,604 divided by 3,010, which will provide us the quotient of 1:86. Thus, the current ratio is 1.86, which indicates that the company or the firm can pay its short-term obligations on time. Ibig sabihin ng ratio na 1.86 sa bawat piso na pagkakautang or short-term liabilities ng kumpanya, may 1:86 silang pangbayad. The next type of liquidity ratio is the quick ratio, also known as the acid test ratio. It is a ratio of current assets, excluding inventory and prepaid expenses, divided by current liabilities. Whereas liquid assets is equal to the current asset less inventories and prepaid expenses like prepaid rent and prepaid insurance. Note that the acid test ratio is a more severe and stringent test of a firm's ability to pay its short-term obligations as and when they become due. The ideal quick ratio is 1:1, but it may also vary depending on the industry where the business belongs. Example of quick ratio for year 2013 using the financial data of Tyson Foods Incorporated. So the total liquid asset is the difference of 5,604 and 2,817 divided by the current liabilities of 3,010, which provides us the current ratio of 0.93 or 0.93:1, which indicates that a company has no sufficient liquid assets to pay its current liabilities and should be treated with caution. The next liquidity ratio is the net working capital. It determines whether a company can meet its current obligations with its current assets and how much excess or deficiency there is. So the formula in finding the net working capital is the difference between current assets and current liabilities. Based on the given value, or given financial data of Tyson Foods Incorporated for year 2023, the current asset is 5,604, while the current liabilities is 3,010. So the difference between current asset and current liabilities is 2,594, which indicates that the company has enough current assets to meet its current liabilities. Now let's proceed with efficiency ratios. Efficiency ratios is also called as the activity ratios or turnover ratios. This type of ratio evaluates how efficiently a company in using its assets and liabilities to generate sales and maximize the profit. The key efficiency ratios include turnover ratio, inventory turnover, and days sales in inventory. Turnover means the number of times the assets are converted or turned into sales. The activity ratio indicates the rate at which different assets are turned over. The inventory turnover. It measures how many times per period, usually a year, the firm sells through its inventory. So gaano kadalas nare-replenish ang inventory ng business or ng isang organization. To be accurate, the firm should use an average inventory rather than a year-end inventory. A high ratio indicates that a company is efficient in managing its inventories. The formula in finding inventory turnover is the quotient of sales and average inventory. Based on the given example of the financial data of Tyson Foods Incorporated, the sales of Tyson Foods is 34,374, while the inventory for year 2013 is 2,817, and for 2014 it's about 3,274. So to determine the average inventory, all we have to do is add the inventory for year 2013 and 2014, then divide it by 2. Thus, the inventory turnover of Tyson Foods Incorporated is 12 times, which means that the firm is able to dispose their inventory up to 12 times a year. Days inventory outstanding. It is also known as the inventory turnover in days. It represents the number of days inventory sits in the warehouse. In other words, it measures the number of days from the purchase of inventory to the sale of the same. So the formula in finding days inventory outstanding is equal to 365 days divided by to the inventory turnover. So based sa nakuha nating value ng inventory turnover, which is 12 times, the next step para makuha natin yung days inventory outstanding ay kailangan lang nating i-divide yung 365 days by 12 times. So the value of days inventory outstanding is 30 days. It means that the firm has enough inventories to last the next 30 days, or it will turn his inventory into cash in the next 30 days. The next efficiency ratio is the accounts receivable turnover. It is the annual credit sales of the firm divided by the average accounts receivable. It measures how many times a business can collect its accounts receivable. Higher ratios means that companies are collecting their receivables more frequently throughout the year. So the formula in finding account receivable turnover is equal to the annual credit sales or sales divided by the average accounts receivable. Example, so since hindi available ang value or ang data ng credit sales, gamitin muna natin yung value ng sales, which is 37,580. divided by the average account receivable. So, yung value na account receivable for year 2013, which is 1,497 added to the account receivable value in 2014, which is 1,688.84 rather, divided by 2. So once we divide the credit sales or sales to the average account receivable, it will provide us with the account receivable turnover of 12 times, which means that the firm collected its average account receivable approximately 24 times over the fiscal year. So, account receivable turnover is related to the average collection period, which is also known as the days of sales outstanding, which describes the average time it takes to collect the accounts receivables. So the formula in finding average collection period is equal to 365 days divided by account receivable turnover. So base sa value ng account receivable turnover, which is 24 times na na-determine natin kanina, all we have to do is to divide 365 days by 24 to get the average collection period of 15 days, which means that the firm collected its account receivable approximately in 15 days. So nakakakolekta sila ng kanilang pinautang within 15 days. The next efficiency ratio is the fixed asset turnover. It calculates how efficiently a company in producing sales with its machines and equipment, which includes investment in property, plant, and equipment. So the formula in finding fixed asset turnover is sales divided by the average fixed assets. So gamitin pa rin natin ang financial data ng Tyson Foods Incorporated. So the sales is 37,580. So to get the average fixed asset, all we have to do is add the fixed asset or the value of the property, plant, and equipment for year 2013, which is 4,053, added to the value of property, plant, and equipment in year 2014, which is 5,130, divided by 2. Thus, the fixed asset turnover is 8.18, which means that 8.18 of sales is generated for every dollar invested or every dollar investment in fixed asset. The total asset turnover. It measures the overall efficiency of a company in generating sales using its asset or average total assets. It gives investors and creditors an idea of how a company is managed and uses its assets to produce products and sales. The formula in finding total asset turnover is sales divided by average total assets. Based on the financial data of Tyson Foods Incorporated, the value of sales for 2014 is 37,580 divided by the total assets or average total assets. So the total asset in 2013 is 12,177 added to the value of total asset in 2014, which is 23,956 divided by 2, which provides us with the total asset turnover of 2.08, which means that for every amount of total asset, the company generated 2.08 in sales.